Hey everyone, my name is Mike, and I want to welcome you to this webinar. If you're one of the millions of homeowners with a 30-year mortgage and want to pay it off in 5 to 7 years, you need to watch this webinar. This webinar is for anyone looking to get out from the stifling burden of debt. It's for anyone who wants to completely eliminate their mortgage debt in record time. And most importantly, it's for anyone who wants to get their lifestyle back and enjoy financial freedom. In this webinar, I'm going to introduce you to a revolutionary web-based software program called the Worth Account. It is the most effective product on the market today for eliminating all your consumer debt as fast as possible. This includes mortgage debt, car loans, credit card debt, student loans, medical bills, and more. I'm going to show you 2 short videos. The first video is going to show you a simple overview of the program, the banking principles it was built upon, and how it works. And the second video is going to demonstrate how the actual software works using real-world financial situations we encounter every day. So let's get started.
Hello. I'd like to introduce you to a revolutionary program that since 2004 has helped thousands of homeowners all across America get ahead financially and on track to save millions of dollars in interest payments on their mortgages and other debts. And as a result, eligible homeowners are now able to pay their 30-year mortgages off in as little as 5 to 7 years, all without changing their current lifestyle and without any refinancing required. Paying off your mortgage is a lot like taking a road trip. However, instead of you choosing the route, the bank hands you a map with each and every turn they want you to take. It's an exact schedule of payments every month for 30 years. And the bank's schedule is not the fastest route. In fact, their schedule zigzags and goes on and on for miles of unnecessary distance. Are there better routes? Absolutely. The closest distance between 2 points is a straight line, correct? Well, this program shows you the straight line and how eligible homeowners can fly through their mortgage in as little as 5 to 7 years. How does this program get you paid off so fast? Before I share this secret, I want you to understand that banks are very good at building wealth with your money. As an important part of their wealth building strategy, the banking industry has taught us to keep our money separate. What do I mean by separate? Well, we are taught to set up our checking and/or savings account and deposit our money over here. And we're taught to take out our loans and make payments to those loans separately over there, never combining our positive cash accounts with our interest-charging loan accounts. But who benefits from this separate account structure more? You or the banks? To understand why we are taught to manage our finances separately like this, we need to understand some basic principles of banking and money and how it works. Each time we deposit and hold money in our checking and/or savings accounts, also known as deposit accounts, the lender makes money off of interest by lending our money out in the form of loans to borrowers. And each time we take out a loan, the lender again makes money each time we pay them an interest payment. So let's go over a couple quick examples of how our money helps the lending industry build wealth. Let's say, based on the money account holders like you and me have deposited in our checking and savings accounts, the bank lends out $5,000 to other borrowers in the form of credit cards. And while we earn close to 0 interest on our money, the lender earns around 18% interest on those credit cards. That means that the lender was able to earn roughly $900 in interest annually based on our money, while we earn close to 0. As another example, let's say we take out a 30-year, $300,000 mortgage at 4.5%. 4.5% doesn't seem like it would add up to much, does it? But over this 30-year mortgage, we would pay over $247,000 just in interest payments. That's actually over 82% of the original loan amount you borrowed, just in interest. quite a far cry from the seemingly reasonable 4.5% rate, right? By following this simple concept of holding billions of dollars worth of banking clients' money on one side, and then lending our money back to us with interest on the other, the lending industry is able to build tremendous wealth. Now think about this. With all things being equal, the more money we owe, the more interest they collect. And the less money we owe, the less interest they collect. So, if banks make more money based on the total amount we owe, there's one guaranteed way to reduce the total amount we owe immediately. What if, instead of following the bank's map of keeping your accounts separate, you could actually transfer or merge the money in your deposit accounts against your loan accounts, literally decreasing the total amount owed immediately. By doing this, it would instantly bring down the amount you owe, and thus reduce the amount of time and interest the bank has you scheduled to pay. Again, the less money you owe on your debts, the less interest you will pay, right? So naturally, the next question is, if I do that, how will I have access to my money to pay my bills? Great question. Because mortgages are not liquid, money goes in, but not out. So, is there still a way for you to access money to pay your bills? The answer is yes. And thousands of people across the U.S. are on track to save millions of dollars in interest payments using this exact method. The answer is through what's called the Worth Account. The Worth Account is a smart online financial system that utilizes an advanced line of credit and calculates specific amounts of money to transfer from your advanced line of credit to strategically pay down against your loan balances, thus lowering the balance in which interest accrues and canceling an optimum amount of time and interest charges on your loans. Then, on specific dates, the program will direct you to transfer or deposit a precise amount of money from your checking and/or savings account against your advanced line of credit to cancel interest charges there. And as you need money to pay your monthly expenses, you simply draw it out through your advanced line of credit. Then, on your next pay date, the program will again prompt you to transfer a precise amount of money from your checking and/or savings account against your advanced line of credit to cancel out interest charges there. And as a result, the money that would normally just be sitting idle in your checking and/or savings account, earning close to zero interest, is now sitting against your loan balances, working hard for you to effectively cancel out interest charges and years' worth of mortgage payments. And again, anytime you need money for your expenses, you can simply access it through your advanced line of credit. The Worth Account is like having 100 accountants working 24/7, calculating and strategizing the exact timing, amount, and frequency of each transfer in order to achieve some of the greatest time and interest savings imaginable. And it's as easy to use as point and click. And as you can see, you are now canceling out an optimum amount of time and interest charges with each and every step you take. And by continuing to follow the program's cycle of strategic transfers and deposits, you literally change your mortgage schedule, effectively canceling out tens to hundreds of thousands of dollars in scheduled interest charges, and accelerate the payoff of your mortgage and other debts to a fraction of their regular time. What's that you say? You don't currently have a line of credit, but you would like to start saving time and interest right away? Well, we have you covered. Most homeowners start with our Phase 1 option, which utilizes just a checking and savings account and follows a similar transfer strategy to save you significant time and interest. Then, once you have a line of credit set up, the program can save you even more time and interest. Now, do you remember our $300,000 mortgage example? The mortgage that would normally charge over $247,000 in interest charges over 30 years. Well, by using the Worth Account, this same mortgage could now be 100% paid off in as little as 5 to 7 years, with only $68,000 in interest charges versus $247,000 in interest. That's a savings of $179,000 in interest and 25 years worth of canceled mortgage payments. And the Worth account doesn't just work on mortgages. It also strategically identifies the fastest way to accelerate the payoff of all your debts. We know that you and your family are unique, and no two homeowners' finances are the same. In just a few minutes, the Worth account system can tell you how much time and money you can save. Maybe your payoff is 10 years, maybe it's 7, or maybe it's 5. What's your debt-free number? What could you do with up to 23 to 25 years worth of mortgage payments back in your pocket? Imagine now being able to invest that money and earn interest instead of just handing it over to the bank. It's things like this that change our financial future and puts a big smile on people's faces. Of course, you can see why the creators of this award-winning program have been featured in magazines such as Broker Banker, Real Estate Investor, and Success from Home magazine. They've also won the Ernst & Young Entrepreneur of the Year award in the financial services category. Please be sure to get back with the representative who sent you this video and ask them to run a free savings report that will show you just how much time and money the Worth account can save you. What's your debt-free number?
Now, what would you do with 23 to 25 years of mortgage payments back in your pocket? A simple savings analysis is all that is required to see exactly how much you can save and how quickly you can become mortgage-free. But before I show you how to get a free savings analysis, I want to show you how the software works 24/7 to improve your financial lives.
Welcome to the most beneficial cash transformation system in the world. This is the first step in taking control of your financial future. This intuitive online system enables you to use financial strategies that the banking industry has used for decades to transform scheduled interest payments into wealth. Here you will maximize your cash flow, increase your net worth, and pay off your debt in record time. At this point, you may be asking yourself, how is this program different than every other financial tool out there? Well, simply put, most financial tools currently available tell you the same old thing, what you've done in the past. But this is where the biggest problem lies. You cannot change the past, so why dwell on it? Never before has a system existed that shows you where you are today, where you're going tomorrow, and exactly how to get there. One of the best things about this program is that it works for consumers in many different financial situations. To illustrate this, we would now like to introduce you to another homeowner example, John and Rebecca Jones. When you first log into the program, there are a few things you will find different than any other financial tool you have seen. For instance, at the top, you will see what we refer to as your financial dashboard. Just like a GPS in your car, the financial dashboard shows where you are, where you're going, and how quickly you will get to where you want to be financially. And because the program monitors your finances 24 hours a day, 7 days a week, if you make a wrong turn financially, the program recalculates based on your current situation to get you back on track, thus helping you to achieve your true financial potential. These financial dashlets or focus points can be changed to show you additional information, a few of which are years to pay off, interest saved, and interest remaining. Below the dashboard, you can see 4 easy navigation points on the left: action plan, budget, accounts, and reports. To the right, you can see settings, help, and log out. Let's go to our accounts tab. From here, let's select mortgages. Here we can see that John and Rebecca have a 30-year first mortgage for $200,000 at 5.25%, with a monthly payment of $1,104.41. In their creditor's loan section, we can see that John and Rebecca have an auto loan for $25,000 at 4.5% with a payment of $466.08, a MasterCard for $5,500 at 18.49% with a payment of $99, and a signature loan for $2,400 at 17.9% with a payment of $139.65. All of these loans add up to $232,900, which the principal remaining dashlet shows us at the top left here. John and Rebecca also have a checking account with a balance of $500, which is also their minimum balance. This means the program will not use this $500 to pay off debt. In their savings account, they have a balance of $5,238.89 and a minimum balance of $4,530, which the program will not use. Now let's go to our budget tab. This is where you set up income and expense budgets. Here we can see that John has an income of $1,314 semi-monthly, and Rebecca has an income of $2,417 monthly for a total monthly income of $5,045. From here, we can also review their living expenses. We see that John and Rebecca have a living expense budget of $2,850. In other words, this is what they will spend each month on gas, groceries, utilities, and so on, with $415 allocated for food, $300 for bills and utilities, broken out, and $2,135 for everything else in the month. When we add in their loan payments, we can see that their total monthly expenses come to $4,659.14. The Budget and Accounts tab is what makes up the Action Plan and is how the Action Plan is built. From these two sections, the program is constantly looking ahead to predict what and when bills and income are due, and from there suggest strategic funds transfers throughout our payoff time to help us achieve our financial goals. Now let's go to the Action Plan tab. The Action Plan is a dynamic snapshot of your deposits and withdrawals laid out in the order they are due. The dashboard is where the program displays the results of our actions and shows us where we are headed. Now, let's see how the Action Plan and the dashboard communicate with us. First, we will change our principal remaining dashlet to years to payoff. Here, we can see that John and Rebecca's 30-year mortgage, auto loan, signature loan, and credit card balances totaling $232,900 will all be paid off completely in only 11.9 years. Now, let's change our principal paid dashlet to interest remaining. Here we can see the interest they are scheduled to pay is cut down to $81,457 from over $225,000 that they were scheduled to pay in interest before starting on the program. This is a savings of over $143,000 that John and Rebecca will never have to pay the bank simply by following the program. Now, let's change their principal remaining dashlet to interest saved. On the left of the dashlet, we can see their potential interest savings of $143,755, and the program will track their actual savings in real time as they follow the prompts of the Action Plan. In order to show you how impactful the program is for John and Rebecca, we will log into their exact same account by opening a separate web browser to show you the before and after effects of each action we perform in their program. John is paid on commissions, and this week has not been the best week for John, so he's expecting a smaller than normal paycheck. He selects his paycheck and adjusts the amount down to what he expects to receive, $1,100, because he wants to see how much an impact that smaller check will have on his finances. Then saves it to the Action Plan. We can see that the interest remaining dashlet has gone from $81,457 to $81,623, which is a long-term difference of only about $166. So John's able to breathe a little easier. We can also see the funds transfer, which was scheduled to our MasterCard for $1,073, has been decreased to $859. This is because of the decrease in the expected income. The program is always looking ahead to save as much time and interest on your debts as possible, but recalculates when things change to keep you on course. Let's go ahead and update the Action Plan on the left side. Now, John receives his actual paycheck, and it came in even lower than what he expected. It came in at $950. John records that in his Action Plan by clicking Final Transaction and clicks Execute. Once John does this, we can see our interest remaining has increased from $81,623 to $81,886, a difference of about $262. This means that the reduced income will result in having to pay a little more interest on their debt long term. We can also see the funds transferred to the MasterCard and savings account have been rescheduled to the following month. Thus, we can see the program recalculates based on what has happened. Now, let's update the action plan on the left side. Now, we'll do a multiple execute and select these actions at the same time. By executing these actions, John is telling the program that they have been done in real time. We are executing our mortgage payment, signature loan, Rebecca's paycheck, our gas bill, and selecting final transaction. We are also going to tell the program that they spent $215 out of the food and dining budget. But we won't select final transaction on the food and dining budget as they are not done with groceries for the month. This will leave the food and dining budget on the action plan. Now that we've completed these items, the program shows our interest remaining has decreased from $81,886 to $80,975, which is a difference of $910.80. This difference comes from the interest paid on our signature loan of $35.80 and our first mortgage interest of $875, as we can see here. Now, let's update the action plan on the left side. John has received his second paycheck. John kicked it into gear and ended up getting a paycheck of $2,410. Now, we select Final Transaction and click Execute. Notice the years to pay off have decreased from 11.9 years to 11.8, and the interest remaining has gone from $80,975 to $79,721. This is a difference of $1,254. We can also see that because his paycheck came in for a little more, the program has generated new funds transfers to execute. Let's update the action plan on the left side and execute these three transactions. We've updated our food and dining budget to Smith's Groceries, and we've selected Final Transaction. After executing these actions, notice our interest saved dashlet has gone to $7,968, showing us how much interest we've saved so far. The dashboard is showing John and Rebecca the progress they're making every step of the way. John and Rebecca then get some exciting news. Their daughter Katie is getting married. But along with this comes the cost of paying for a wedding. So John adds a new action estimating the wedding to cost around $7,500 and anticipates the wedding to be on November 30th. Once added, their years to pay off will go from 11.8 to 12.3. And we see their interest remaining has gone from $79,567 up to $86,829, which is a difference of $7,261. This means they will pay $7,261 more in interest because of the $7,500 wedding expense, which we added down here. We also see they had a funds transfer in July to their MasterCard, which has been removed due to the wedding. So again, the program always shows us the cause and effect of each action, similar to how a great financial planner would inform us. Now let's update the action plan again on the left side. Katie then informs John and Rebecca that the confirmed wedding date will actually be on June 30th, 5 months sooner than originally estimated. So John simply enters the confirmed date and saves it to the action plan. As he does so, we can see the years to pay off go up from 12.3 to 12.4, and the interest remaining has gone up from $86,829 to $87,501, which is a difference of $672. We also can see that John and Rebecca will now need to borrow $1,509 on the MasterCard to be able to pay for the wedding on June 30th. Now let's update the action plan on the left side again. Later on, John and Rebecca get the bill for Katie's wedding, and it turned out to be $12,500, far more than the $7,500 they had estimated. John and Rebecca then take a deep breath and update the cost. As we can see here, their payoff has gone up from 12.4 years to 12.8 years, and the interest remaining has increased from $87,501 to $95,508, which is a difference of over $8,000. Because of the higher than expected wedding expenses, you'll also notice that instead of having to borrow only $1,509, they're going to have to borrow $6,509 from the MasterCard to pay for the wedding, as they will not have enough cash available. Now that we've seen the comparison, let's update the left side. Now let's go to the Accounts tab. John has been approved for a visa of 8.9% with a credit limit of $8,900. Once the account is added, John clicks Save, and the dashboard will immediately show how this new visa will impact their long-term finances. We can see that their payoff time has decreased from 12.8 years to 12.7. Why? Well, let's take a look at the action plan. The action plan is now asking John and Rebecca to borrow funds for the wedding from the new Visa instead of from the MasterCard. This change results in savings of over $3,100 in future interest cost. That's a big difference in our interest remaining from $95,508 down to $92,390. The program looks for every strategic advantage 24 hours a day, 7 days a week. All it needs to know is the accounts available, and it automatically maps out the most strategic plan to maximize your time and interest savings. Now let's update the action plan on the left side. The $3,100 in interest savings has John and Rebecca feeling pretty good, and they say, you know what? We're about to be empty nesters, and we want to travel the world a little bit. What would happen if we bought an RV? So, they enter the purchase price of the RV, which is $95,000 for 120 months at 2.5% and a payment of $895. Then Rebecca says, let's do this after Katie's wedding. So they hypothetically set up the first payment to occur on July 22nd. Now remember, the program will not lie to us. It will only tell us the truth of where we are today, where we are going, and exactly what's going to happen along the way. As we can see, with the changes made, the dashboard changes to insufficient funds, which means if John and Rebecca proceed according to their plans with the RV, they will run out of money. Let's zoom in on the dashboard to take a closer look. The dashlet shows your expenses will exceed your available funds on 7/31/2017 by $756.11. Only $619.91 available in all other accounts. The interest remaining dashlet shows $35,995.69 in interest before they completely run out of money in July 2017. If we change our interest remaining dashlet to time to exceed, we see John and Rebecca will run out of available funds in 27 months. Can you imagine if John and Rebecca had bought that RV without the knowledge from this program? They could have been in some real trouble 27 months from now. So, John and Rebecca started looking at used RVs and find a similar one for $62,000. So they enter that price, and the program shows their payment as $584.47. Before adding the RV to the program, we were at 12.7 years. With the RV, our payoff goes up to 17.8 years, and the interest remaining has increased from about $92,000 to over $164,000. This is a huge difference for John and Rebecca. Buying an RV, even a used one, will cost them over $72,300 in additional interest. So, John and Rebecca start reasoning this out. Before we started using the program, we were going to pay off in 30 years, they say, and now we're down to 17.8 years, even with an RV and paying for a wedding. That's not so bad. They decide that although they love the 12.7-year payoff they had before, they are going to go ahead and buy the RV. That's what people love about this program. It helps us to achieve our dreams and do the things we love while making educated decisions that help us to get ahead at the same time. Let's update the action plan on the left side to reflect the RV loan. Now, remember, we were at 12.7 years to pay off before the RV, and now John and Rebecca would really like to get back down to that number. So John decides to see what it would look like if he took up a handyman side business he hasn't been doing for a while to see if they can get their payoff back down to 12.7 years again. John decides to plan on about $550 of income per month from the side business. So he adds that to his program, which takes him from 17.8 years down to 12.3, and from $164,752 in interest remaining down to $99,861, a savings of $64,891. In addition, they only have to borrow $4,859 from their Visa instead of $6,509, a difference of $1,650. John and Rebecca are so excited about this. The program calculates everything down to the penny, all the way out until everything is paid off. It sees exactly how much we're going to have to borrow before we borrow it, where the best place to borrow from is, along with showing us the actual cost, which helps us make educated decisions that will actually benefit us and help us to think before we act. Then, simply lays out the exact plan for us to follow. Let's update the action plan on the left side. Rebecca wants to see if they can save even more time and interest. Rebecca calls their cell phone provider and negotiates their monthly bill from $150 to $107, a decrease of $43 per month. Now, experience has taught us that most people would just find another way to spend that $43 every month, which means you really wouldn't be saving anything. But remember what the program does. It looks at every situation to maximize every penny. For some people, $43 does not seem like much. But let's see what the program can do with that $43 per month. Currently, we're at 12.3 years to pay off and $99,861 in interest remaining. After decreasing the cell phone bill, however, we're down to an even 12 years with only $97,153 in interest remaining. That seemingly insignificant $43 used strategically is going to save John and Rebecca over $2,700 of future interest. This also changed the amount that we'll need to borrow from the Visa. Instead of borrowing $4,859, we're now borrowing $4,730. John and Rebecca are really excited about what the program is doing for them. They wonder, though, if they should focus on paying off the RV before everything else. After all, they reason, it does have a pretty high monthly payment, and John would really like to have it paid off. So they come into Settings, click on Preferences, and change their program focus setting from automatic to the RV loan, which overrides the program to pay off the RV loan. Immediately, the program shows us that if they focus on paying off the RV first, their interest remaining and years to pay off will increase from 12 years to 12.3, and from $97,153 of interest remaining to $105,061. This means if they override the program and do not let the program do its job, but force it to focus on the RV loan first, they will pay in excess of an extra $7,900 of interest on their debts and take over 3 months longer to pay off. Having seen the cost of overriding the program's strategies, they change the program focus back to automatic. John then says to Rebecca, what if we tell the program we want to save up $47,000 before we pay off debt, instead of the minimum balance we currently have of $4,530 in our savings account? He makes that change, and the program shows it will take 81 months or 6.75 years to build up. Their payoff time has gone up from 12 to 14.1 years, and their interest remaining has increased by over $27,000. Now they decide saving up a minimum balance of $47,000 in their savings account, which only pays them 0.5% interest, is not worth the increased interest and payoff time. So they decide against it and change it back. Now, the important thing to remember is that all of these decisions have been John and Rebecca's to make. Although the program shows them the impact of their decisions, John and Rebecca are still in control of their finances and can do whatever they like with their money. But with the help of the program, they are now making more educated decisions based on strategic calculations rather than emotions and guessing. So what has the program done for John and Rebecca? It has simplified their life and will help them save 18 years of mortgage and other debt payments and over $135,000 in interest payments. It will also help them pay for a wedding, purchase and pay off an RV. And on top of that, they're scheduled to pay off on April 15th, 2027. At that point, if they continue to deposit the payments they were paying towards debt into a simple savings account, earning just 0.5% interest. At the end of 2027, they would have over $27,000 in their savings account. And by the end of the year 2045, the same time they would normally just be paying off their 30-year mortgage on their own, they could instead have over $660,000 in their savings account. This program shows you the cause and effect of virtually every financial decision you make and provides you with proven strategies to turn ordinary finances into extraordinary results. In short, it will guide you on how to reach your true financial potential. Can you imagine where you would be today if you would have known about this program like John and Rebecca 12 years ago? Does the thought debt-free and building wealth come to mind? We are confident that this program will give you a sense of renewed hope and bring relief to the seemingly never-ending financial burden for many individuals and families like John and Rebecca. To see what this program will do for you, be sure to ask about our free savings.
Now I know the real question on everybody's mind is how much does it cost? Well, that's what's really cool about how they do it. They don't charge you for the analysis, and the fee works out to about 0.5% to 3% of the amount the program is projected to save you. So if you're not projected to save anything under the program, you don't pay anything. And the higher amount you save, the lower the percentage is to take advantage of the program. But because you're on this webinar, I have a special offer. We are running a special promotion that lets you test drive the software for a full 90 days. We will run your analysis to see what the program can save you. It comes with full use of the program, plus all training and support. And under this special promotion, you get it for only $250. Then, if you decide you like the program and you want to continue, this is credited towards the purchase. So if interested, here's what you need to do. First, get your free analysis run. Second, test drive the program for a full 90 days. And third, see what it can do for you and your financial situation during the trial period. The question you need to ask yourself is, how quickly do I want to become debt-free? So if you're interested in having your savings analysis run, please enter your contact information using the link provided, and a good time to call. I will call you to schedule a time to run your analysis. Then, at the scheduled time, you will have received a link to a one-on-one webinar, where we will call you to get you online, load all your income and expenses into the software. You will need to set aside about 45 minutes and have access to a computer. Once completed, you will receive the results showing how much time and money you can save and have the option to sign up at the promotional rate. So please have all your income and expense information collected before the call. Finally, I want to thank you for taking the time, and I look forward to talking with you.